ADB, the Asian Development Bank, just coming out with its latest Asia Bond Monitor, focusing on the impact of the EU crisis on currency bond markets on this side of the world. Iwan Azis is head of the Office of Regional Economic Integration at the ADB, and joins me and Graham Maxton from the Insight Bureau, who's our guest host for this hour, couple hours actually. Iwan, welcome.
Thank you.
To the program. Interesting thing, given the external pressures that have been in the system for so long, you would think that this would have a negative impact on local currency bond offerings, but that's been anything but the case. It's gone the other way. I've seen something like 8.5%, 9% increase in aggregate on a year-on-year basis. How did that happen?
Okay, two things. One is that the market is still seen as quote-unquote safe haven. I have to put quote-unquote there because certainly it's not the same like the case 2 years ago during the global financial crisis. But the second is also the fact that the corporate sectors find it's more difficult and more expensive to get the funding from the banking sector. And if you look at the spread, for example, between the bond yield and the interest rate in Asia, it's definitely still there. So in other words, from the commercial point of view, as well as from the fact that the liquidity is there, that explains why the bonds market is still doing well.
Some kind of a silver lining here, huh, Graham?
It sounds like it. But don't you expect some things to slow down in the next sort of 12, 15 months?
Oh, absolutely, no doubt.
So how will that affect the bond sector?
No, I don't think it will affect dramatically because, as you just said, earlier Bernie mentioned about the slowdown in China. As a matter of fact, the slowdown in the entire world. And that itself will affect the slowdown in terms of the capital flows, which also translate into the slowing down of the bonds market. And the question here also, the policymakers, what happened with the interest rate? Because that will determine the bonds market.
But it'll stay a safe haven, presumably.
I think so. Yes, we believe so.
What about the mechanics underneath the skin of all this? Because it wasn't too long ago, everybody kind of waxed lyrical and talking, voluminous terms about dim sum bonds and renminbi-denominated bonds. And now that the offshore and onshore markets are completely boring and we're seeing outflows from renminbi, I kind of wonder whether that was a bit of a flash in the pan, a bit of a passing fad, or what. Can you tell us about the development of some of these newer initiatives?
Well, the key when we're talking about the offshore yuan, including the dim sum, is basically two things. One is the flows, of course. I mean, being the world economy is slowing down and so forth. But the second, also more important, is the expectation with the exchange rate, with the yuan. Now, a year ago, the expectation was still there that the yuan is getting stronger, but definitely it's much less than a year ago. So that explains why there's a slowing down in the dim sum and as well as the offshore.
You want Grant? Grant, want to bring in my partners from the SGX over in Singapore?
Hello. Good morning. I just want to get your sense of how more stimulus or quantitative easing from the Federal Reserve in the United States will affect Asian bonds.
So the question is about the effect of more stimulus in the U.S.
Yeah, what do you see?
The QE3.
Exactly.
Yeah, now after we hear what Ben Bernanke said, I think the likelihood is bigger there. Now the question is, what will be the impact on Asia, including the bonds market? I think it's more likely that the most important determinant is not so much flows, which means it's less from the QE, if there is QE3, but it's more on the policy response of the authorities in the region. And that's what I said earlier, whether the authority is now doing something with regards to the bonds market, interest rate, monetary policies, and so forth.
Let me throw a wild one out here. But if it looks like the U.S. is going to keep easy money going until 2015, or what are the chances of the dollar becoming a carry trade of sorts? I mean, you can fund very cheaply because your interest obligations are going to be so manageable and so clear for a number of years. What's the potential for that?
I think the risk is that you're going to see the dollar going down in value. Because they're printing money, they're going to have inflationary pressures, the dollar will go down, and then you've got all these currencies in Europe, which are tied, in Asia, which are tied to the dollar. They're going to find themselves in greater trouble as well. So the risk is much more on the inflationary side, I think. I mean, we'll see potentially some sort of carry trade, but anybody who's tied to the US dollar is going to find themselves in trouble as well.
Where's the inflation going to come from, though? I mean,
you're printing money.
QE3 in itself isn't going to be inflation.
No, but I mean, you're printing money, and you're devaluing your currency in the process.
Okay. Finally, is there, in terms of geography within Asia, because, I mean, we only take extracts because this report is like that big,
Correct. Yeah.
right? I mean, what are the standouts in terms of outperformers, really big surprises in terms of development of the credit markets, and perhaps what, is still a work in progress?
Well, if you're looking at the growth rate, I think the prospect is so far the best is in the small market like the Philippines, Indonesia, and so forth. And definitely the big market is slowing down. Now, what is interesting is Korea stands out, the Korean market, because if you look at Korea, the growth of the bonds compared to the growth of the credits, bank credits, bonds has been always higher than the growth of the bank credit. So that is the only standout kind of a case.
Bonds, not banks. Okay,
Yes.
appreciate your time. Okay, thanks for stopping by.
Thank you.
Iwan Azis, head of the Office of Regional Economic Integration at the ADB. Graham will remain for some time to come.